the diversification to stocks and bonds. And like I said, this is obviously, the world that I have come from. And the entire idea and really kind of what advisors always pitch to their clients is we've got to have a well-diversified portfolio. So when X is up or down, this one is acting in a different manner and essentially protecting us from any volatile movements. And what we've realized, and the data clearly says this, you can look this up, your advisors may be a little misinformed. They typically have what's called a style box, both in the equity and the fixed income space. So it'll look like a tic-tac-toe little chart there, and they'll have small cap value and small cap blend and small cap growth, and it'll go mid cap, large cap, and then really the same thing on the fixed income side with credit quality and duration. So how long those coupons are out there for. And interestingly enough, stocks and bonds, their correlation is right around 0.44. A correlation of 1, you move in tandem. A correlation of 0, you don't move at all. And then a negative correlation, you move in an opposite direction. And really what I've seen out there, some of the data, is direct real estate, actually owning the asset class, is a 0 correlation. That to me really provides the diversification that an investor needs to mitigate that volatile, wild Monday that we saw yesterday. We didn't see any of that owning real estate. Granted, we also don't have, as a liquid marketplace for that, but we didn't feel that.
No, not at all.
This goes back to the volatility, the Sharpe ratio. I can't hammer it enough, but when looking at any asset, risk versus return has got to be top of mind, right? In fact, just more specific to Zuber's world, when I get investors saying, well, I can get this property in this D-class neighborhood, 15% return. It's like, again, an extra $100 for a lot more headaches, so that's a volatile asset in real estate. But if you're buying good assets, fixed debt, as he mentioned, you hold it for 10, 15, 20 years, you're going to be doing just fine.
Yeah. The other thing too, what I thought was always interesting, and this is the conversation, because a lot of what I do day to day is not just work with accredited investors. Most of my deals, I'm working with family offices, the RIAs in the space who are embracing direct real estate as a portion of their clients' investment portfolio. And, we always have this conversation. Well, I'm getting my exposure through these publicly traded REITs and even these non-tradable REITs like a Blackstone. But the reality is publicly traded REITs have a correlation of 45. You're almost getting the exact same correlation as you would in the bond world. So what real diversification other than, the headline and the name of your mutual fund or investment product that says REIT, you're getting exactly the same correlation. So when it comes to diversification, to me, it's diversifying the correlation of how these investments work together. It's not just the name, right? It's the actual correlation. And when you're actually building portfolios, the portfolio construction correlation is everything. Now, the fact of the matter is you're not liquid. And I think that goes to really kind of understanding each individual investor and knowing what they can afford to not have readily accessible.
Mitch, also too, just to hammer on the point of cross assets, it's called cross asset correlation, if I'm correct. The most savvy portfolio managers obviously use this. But one of them, as you may know, is Ray Dalio. He has a great YouTube video about cross asset correlation. And he's all about managing that, that risk versus return, most commonly famous in his all-weather portfolio strategy, right? So it's an absolute tidbit that any savvy investor should be thinking about. So, but back to your next point, Mitch.
I wanted to talk about liquidity because that is for some a negative, right? If you need fast access to your dollars, real estate's not your thing.
Yeah, no question. And we'll talk a little bit more about the illiquidity of real estate on the second half of this. We'll kind of talk about just, the 3 disadvantages to real estate. And that's certainly probably, in my opinion, the biggest one. But one of my favorite parts, and I think Zuber, you'll be able to give the most amount of insight into this, but the benefits of cash flow when it comes to real estate and what that can do. And that kind of goes back to that Rich Dad, Poor Dad book, which was probably the first book that I ever read that was of interest, because most books that I read in high school or college, they were probably pretty boring to me. This one was the first one that grabbed my attention and said, holy cow. Yeah. And then it also validated everything they teach in school was worthless.
Yeah, no kidding. There's certainly some missing aspects to high school and college. Yeah. So cash flow is the thing, right? If you want to be rich, you can get there, on Wall Street or an athlete or something like that. It's just an income number, but you got to keep working. Cash flow. Cash flow is how I retired at 45. Cash flow is how I replaced 2 6-figure incomes and have a better lifestyle today than I did while working, right? It is about time. Real wealth is about choosing how you spend your time, with whom, when, all of those things. Cash flow does that, right? And oh, by the way, if you happen to have cash flow built on assets that are also like inflation adjusted and all of that, your lifestyle goes up. As you both know, there's this famous 4% rule, right? Spend 40 years working 40 hours and then live on 40%, right? The whole idea is build a $1.9 million nest egg in the market. That's what the most people think you need. And then you just live on 4% of that and hope you don't die or, run out of money before you die. That's one way to go. Why don't you spend 10 years building up a real estate portfolio, get fixed rate debt, and then let inflation be your friend? Right? The only people that won the 1970s, and the 1970s sucked, just in case anybody was wondering. Stagflation sucks. Double-digit inflation sucks. But boy, if you own some real estate where rents went up and all these other things, and you had real cash flow, your cash flow at the end of the 70s versus the beginning would be astonishingly different, because you had the lowest of the lowest rates, you had the lowest cost structure, and all the cash flow, or at least most of it, would fall to the bottom line, and you were living pretty. So get in the game. It takes a few years, but yeah, cash flow is where it's at.